In this video, I will talk you through 4 steps to help you overcome the fear of investing, as fear is recognised as being one of the main obstacles in people getting started with their investment journey. Fear can be a good thing generally and helps keep us from physical danger, and is a risk assessment tool that we use to make decisions. We stay away from cliff edges, steer clear of venomous snakes, and stay in the shallow end of swimming pools if we're not good swimmers. Some even stay out of the swimming pool altogether for fear of getting their hair wet. And we're all different, with some of us being more adventurous than others. So what makes many of us so risk adverse when it comes to investing? What do we fear, and what can we do to reduce those concerns? Fear prevented me from taking conscious steps to invest until later in life, and I got this fear from the perception that the media gave me about the stock market. Some articles might have displayed some good news headlines, such as all-time highs and massive gains, but predominantly what I would read were attention-grabbing words such as market crash, plummeting stocks, financial crisis, and in the red. It was either all or nothing, and there was never any media reporting on the everyday mundane workings of the stock market. But I guess that to do that would not have sold newspapers, even if that would have provided a more accurate picture of what investing actually is, and that is that investing is slow and boring if you were being sensible. My perception of investing was that it was fast and furious, and that I would have to be in the right place at the right time, making split-second decisions. The fear that I had was that I would not get the returns to meet my financial objectives, and would lose some or all of my money if I wasn't on top of my game. I certainly didn't think that investing was for me with my working class background and my then little financial knowledge. So I put it off, thinking that cash savings was the only deal in town. It was only when I started taking an interest in my workplace pension that I realised that my retirement pot was an investment and that I was already investing, which didn't match with my perception and fears of what investing was at all. I thought about this more and realised that, along with a little ignorance, there were 4 main factors that had given me a tolerance for risk regarding this, when compared against my original negative perception of investing. So if you believe that investing is something that you should be doing to improve your finances, but have little tolerance for risk and are very cautious when it comes to your money, let's see if these 4 factors hopefully give you a less fearful perspective and hopefully encourage you to get started. If your financial objective is short-term and time-critical, for example to pay off the balance of a car finance agreement, or you have an approaching date to help your eldest with their university fees, then these commitments are likely to weigh more on your mind. And I imagine you're going to choose some sort of cash saving plans to guarantee you what you need. Investing with its ups and downs probably won't give you those reassurances in the short term, and probably would be more appropriate for investing timelines of 3 to 5 years or more. We talked about the doomsday headlines that get pushed out in the media when markets fall. How would you feel if you saw the value of your investments fall in the short term, just as you approach a financial commitment? I imagine that the answer is not great. So a first step on the investment ladder might be about reasonable objectives. Perhaps you should take pressure off yourself by focusing on a longer term objective that you want to achieve. And opening a private pension might be a good example of this if that's what fits with your circumstances. If that same market fall happened when you had that longer term objective, and knowing that markets recover and go on to reach new highs over time, then maybe this wouldn't be so stressful for you. And to emphasise how investing would be a better longer term choice for you rather than cash savings, let's look at some facts. Although past performance should not be a guide to what happens in the future, over the past 100 years, in more than 90% of 10-year periods, the stock market has performed better than cash, with some data putting this percentage as higher. If you intend to grow wealth to meet a long-term objective by using cash savings, you are more likely to fail and could be taking more risk with your money trying to reach these aims than you would if you were investing sensibly. Generally, the less risk you take, the less reward you get, and cash savings is the least riskiest financial option of all. This should tell you that cash will reap you less reward when compared with something like stocks and shares. If you wanted to save cash to provide for a pension when you retire at the age of 60 for instance, the risk of you failing this objective is very high. Yes, you would get a guaranteed lump sum at retirement from those savings, but this is far likely to be less than you would have achieved with investing, and that difference might impact on your quality of life in those later years. To illustrate this, let's compare historic annual average returns from the stock market with those of cash to calculate what you're likely to get back in 25 years' time investing £250 every month. The difference is stark, and that difference is only likely to get larger the longer that you invest for. And the returns that you get from cash will also struggle to keep pace with the cost of living, meaning that you will lose purchase power also. You have a much better chance of getting that growth with investing. So giving it time is not just about alleviating short-term pressures to dilute the psychological fear of investing, but it is also to give you the knowledge that you'll get better returns from investing in the stock market. And those positive benefits that you get from investing will hopefully raise your tolerance for risk also. One of the main reasons that the stock market performs better than cash in the long term is down to compounding. The effect of compounding is often likened to the snowball effect, as that snowball gets bigger as it rolls down the snowy hill and gathers more snow. With cash savings, interest is calculated on your principal and then it gets added to it. The new interest calculated is then on this larger sum, and future calculations just keep on taking interest added to the principal into account. This is reasonably effective, but with investing you have additional power by adding dividend payments and share growth to the accrued interest that accumulates, meaning that there will be far better opportunity for your investments to compound much bigger. This compounding effect gets better the longer that you keep invested, and is one of the primary reasons why investing provides better returns than cash in the longer term. By the way, I'm not saying that you can't invest in the shorter term, and the chance of you beating cash with investing is still reasonable. But if you want better odds, time will help. So time is the first step we take in our fear management toolkit. Let's move on to step 2. In addition to my media-driven negative perception, another of my biggest fears with investing was thinking I would have to choose individual company stocks, and the fear of not being successful at this as I wouldn't know what I was doing. I would then lose some or all of my money if the company I invested in didn't perform well. Even if I decided to spread my money across 2 or 3 different type businesses just to hedge that risk, how would I know which stocks to choose for my plan to work? If the professionals often fail at this, how would I be able to do any better? I would have to research the individual balance sheets of companies. This would take knowledge and time. On top of that, this analysis and research would be ongoing as economic circumstances and company fortunes often change. I would have to pay dealing fees for every individual stock I purchase, meaning that the more I had, the more expensive it would be. I had heard of terms such as passive investing and index funds, but as I had never had any financial education along with a lot of other people in the UK, I didn't have a clue what all this terminology meant, and didn't realise that this would solve my problem of picking the wrong stocks. As with passive index funds, you invest in the whole stock market. I use the word passive as opposed to active, where those active investors are trying to pick stocks to get market-beating returns. Passive investing is just about trying to match market returns by tracking an index and is much less complicated. So rather than investing solely in a company like Tesla, say, if electric cars are your thing, I can invest in a passive index fund that tracks an index that includes Tesla and 499 of the other largest US companies. And in this case, I would be invested in a passive fund that tracks the S&P 500 index. An index is a list of companies that have been grouped together under certain characteristics as a market measurement tool or benchmark. And in the case of the S&P 500s, the companies grouped together are the 500 largest companies that are based in the US. Another example of an index would be the FTSE 100, which groups together the 100 largest companies that are headquartered in the UK. The companies in an index are generally graded according to size, with the biggest taking up the biggest index proportion. This is called market capitalization, but you might see it abbreviated to market cap. As the S&P 500 index consists of large companies, they'd be referred to as large cap. If Tesla, which is currently just outside the top 10 largest companies in the S&P 500, accounts for 1.2% of it, every time you buy a share of a passive index fund that tracks that index, 1.2% of that share should be made up of Tesla, with the remaining 98.8% made up of the other 499 companies. So if you want to invest in Tesla, this would be a cheaper, less volatile and less risky way of doing so. I get that your objective might be more about saving for that pension at the age of 60 rather than taking an interest in individual companies. But I just wanted to pick on an individual company to show you how funds work, but also to demonstrate that you can use funds to invest in your favourite companies if you want to make things a little bit more interesting while still being sensible. If Tesla performs badly, then the 499 other stocks should take up the slack. And this is illustrated in the example and shows how Tesla's price has moved over the last year when compared with Vanguard's S&P 500 ETF that has tracked the S&P 500 index, and the fund's performance is not affected by the fall in Tesla's share price. This is a great example of diversity in action. One thing of note is that by diversifying and investing in a fund, you should expect less reward for the lower risk that diversity gives you. However, if you look at the performance of the S&P 500 index over the past 66 years up until the end of 2023, its average annual return of 10.26% has beaten the average return of cash and rising the cost of living over that time by a long way. Diversity doesn't stop by investing in a fund of the 500 top American companies. You can go global with this and select world funds. Such funds would include those largest American companies, given that the US has the largest proportion in global markets. And there are even blended funds available that add different asset classes such as bonds to the mix, providing even more diversity for those cautious and risk-averse investors. So a longer-term objective alleviates that pressure of having to meet a short-term goal, and the diversity I get from index funds means that I don't have to invest in individual stocks to get good cash-beating returns. I now feel better about starting to invest, but there is something else that might help also. Some people with capital to invest do so with a lump sum deposit at the start. The argument for this method is that your money is in the market for longer, therefore getting maximum benefits from the effect of compounding. This is a valid argument, but if you are cautious and trying to overcome your fears of investing for the first time, what would you do if the market crashed the day after you invested that lump sum and the value of your portfolio dropped, say, 40%? Hopefully you wouldn't do anything, as your financial objective is long term and you will know that the markets have plenty of time to recover. But can you guarantee that you wouldn't react? A lot of investors cash out when the markets dip for fear of losing their money, never to return to investing. But the reality is that if you do this, you will be selling your shares at a low price and possibly end up getting less than you put in. It might sound counterintuitive, but buying rather than selling when the markets are low might be a better idea, as you'll be getting more stocks for your capital investment at a cheaper price. Market low should be construed as a sale and be a good time to buy, not sell. As that famous investor Warren Buffett has said, investors should be greedy when others are being fearful and fearful when others are being greedy. But if your tolerance for risk is low and you're not able to cope with this scenario, then lump sum investing could create a psychological barrier. But there is an obvious alternative for you to overcome this problem, and that is by investing smaller amounts of money on a regular basis. This method is often referred to as dollar cost averaging, or pound cost averaging if you're based in the UK, and is a powerful tool to help smooth out the ups and downs of the stock market. As market prices fluctuate, you buy shares at different prices, sometimes lower, sometimes higher. If market prices are lower, the amount of shares you can purchase with that regular deposit will be more, and vice versa if they're high. But overall, your average purchase price will hopefully be lower than the market price. To demonstrate this, the graph shows my Trading 212 general investing account for the last year, and the dotted line shows the average price that I have paid for stocks when investing regularly, as opposed to the current market value. This gap will hopefully widen the longer that I continue to invest and markets fluctuate. Some great investors, such as Warren Buffett and Jack Bogle, the founder of Vanguard, have stated that the average investor will do well just to invest regularly into a passive index fund and do nothing else. And passive investing through dollar cost averaging into a passive index fund will put you in the top 5 to 10%, as the majority of active investors fail to beat the markets with their attempts of picking stocks. Your long-term goals will dictate how much you need to deposit on a regular basis. And there are lots of calculators out there that allow you to enter your target amount and then give you an estimate of how much you need to invest each month. I've left a link to one that is free to use in the description below. It is worth mentioning that any cash that you hold back for emergencies is still part of your portfolio as a whole and should be taken into consideration. The cash proportion with this low price volatility will potentially help dampen any short-term investment falls to once again help manage your tolerance for risk. The last step to help you reduce your fear of investing is to avoid noise. Whilst it's good to take an interest in your investments, you can sometimes be over-proactive and try to dig too deep into the data to find something negative. This can cause stress and reduce your tolerance for risk. Also, as I mentioned earlier, we are surrounded by social media and news headlines that can influence the decisions that we make. But don't panic if something significant happens, as most events are short-lived, and your diverse portfolio will help balance out any short-term losses. You only have to look at some recent events such as COVID and the energy crisis that was deepened by the conflict in Ukraine to see that markets recover and go on to reach new all-time highs. Perhaps you should make a contract with yourself at the start of your investment journey, not to check your investment balance when something bad happens. The chances are that if you wait for a week or two before checking that balance, the picture will look a lot better. Also, you don't need to check on your investments every day. You will want to do this initially, as this is an exciting new world that you've entered. After daily checking, I eventually realised that short-term movements don't really mean a lot, and checking every 6 months to a year is probably a much better way of appreciating how your investments are doing. Take comfort in the fact that your investments are for the long term, and stick to your plan by not making decisions based on short-term events. And if you want any more information on some of the diverse index funds that you can invest in, this next video shows you some of the best Vanguard funds that are available. Once again, thanks for watching.